What if you could set up just 8 investments and collect dividend income every single month of the year without chasing hype or trying to time the market? Today, I'm going to walk you through the 4-season dividend strategy, a simple plan that blends stable ETFs with reliable dividend stocks to create a portfolio that works year-round. Disclaimer: this video is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Always do your own research before making investment decisions. Most investors build a portfolio without thinking about income timing. You might have a great set of dividend stocks, but if most of them pay in the same quarter, you'll have months with no cash flow at all. That means one month you're flush with income, and the next, you're left with nothing, breaking the consistency you need for budgeting, reinvesting, or even early retirement planning. And here's the kicker: it's not just about when you get paid. Without a plan that blends sector diversification and dividend reliability, you risk holding companies that cut dividends, overlap too much, or worse, lock you into low growth for years. I've been there. I used to own a messy collection of stocks, some with great yields but shaky financials, others with rock-solid fundamentals, but they all paid in the same month. My income looked like a heartbeat monitor: up, down, up, down. It was stressful, unpredictable, and it kept me from really trusting my investments. Then I found a way to smooth out the dividend flow. The idea was simple: break the year into 4 seasons, each anchored by one core ETF for stability and sector-wide exposure, one individual stock to boost yield and growth. Each season has its own focus, giving you diversification across sectors: utilities, real estate, consumer staples, and energy, while still keeping income steady. Season 1, Winter. Utilities, strength. ETF, XLU, utilities. Select sector, SPDR fund. Stock, Duke Energy, DUK. Utilities are the classic defensive sector. They keep paying dividends even when the economy cools. XLU has an expense ratio of just 0.08%, a weighted average dividend yield of 2.83%, and a 10-year average annual return of 10.41%. Over the last year, it returned plus 21.21%. Recent payouts include $0.5574 per share in June 2025 and $0.55503 per share in March 2025, all quarterly. The beauty? Inside XLU, one of the top holdings is already Duke Energy, at 7.36% of the fund. Why hold both the ETF and a stock inside it? Yes, there's overlap, and it's intentional. The ETF gives you broad sector exposure, spreading your risk across 20 to 50 companies. But because that diversification limits the yield, you can boost your income by owning a top-tier stock from within that ETF directly. For example, XLU's yield is approximately 2.83% because it spreads money across many utilities. Duke Energy's yield is 3.34%, higher than the ETF average, with a long record of dividend growth. Owning both means you get the safety net of the sector ETF. You get extra yield and growth potential from a proven leader in that sector. You're not betting your whole season on one company. The ETF balances it. It's like having a team and a star player. The team keeps you in the game, but the star scores the extra points. Now, let's boost that with Duke Energy, DUK itself. DUK offers a 3.34% dividend yield, paying $4.18 per share annually, with a 68% payout ratio, totally sustainable for a utility company. It's been paying dividends for 99 consecutive years and has raised them for 18 straight years. The latest increase? Up to $1.065 per quarter, payable September 16, 2025. Performance-wise, DUK has delivered plus 20.46% total return in the past year and plus 9.11% annually over 10 years. For winter, this pairing gives you steady income and a sector that tends to hold up during downturns. Season 2, Spring, Real Estate Cash Flow. ETF, VNQ, Vanguard. Real Estate ETF. Stock, Realty Income. Oh. When the world wakes up in spring, your portfolio can wake up too, with real estate investment trusts, REITs. VNQ has a 0.13% expense ratio and a 3.9% yield. Over the last decade, it's averaged 5.36% annual returns, with quarterly payouts like $0.868 per share in June 2025. But here's the twist: VNQ already holds Realty Income as one of its top 10 holdings, at 3.01% of the fund. And Realty Income, nicknamed the Monthly Dividend Company, is a powerhouse for consistent cash flow. It yields 5.62%, paying $0.269 every month. That's $3.228 per share annually. Yes, its payout ratio against earnings is a huge 308%, but remember, REITs measure sustainability using funds from operations, FFO, not net income. Realty Income has increased its dividend for over 30 years straight, with 661 consecutive monthly payouts. Since listing in 1994, it's averaged 13.5% compound annual total returns. And that's with monthly income you can literally plan your bills around. Why winter plus spring works together. By combining XLU plus DUK in winter with VNQ plus Realty Income in spring, you already have two high-stability sectors feeding income into different months. Winter gives you quarterly utility payouts, spring delivers both quarterly REIT payments and monthly Realty Income checks. If you're starting to see how this kind of structure could make your dividend income predictable and less stressful, tap the like button. That lets me know you want me to break down more income smoothing strategies like this. Season 3, Summer, Consumer Staples Resilience. ETF, XLP, Consumer Staples, Select Sector, SPDR Fund. Stock, General Mills, GIS. In summer, the focus shifts to consumer staples. The companies selling products people buy no matter what's happening in the economy. XLP charges just 0.08% in fees, has a 2.74% yield, and returned 8.4% in the past year. Its top holdings include Walmart, Costco, and Procter & Gamble. Household names that have been around for decades. Payouts are quarterly, with $0.55233 per share in June 2025 and $0.41824 in March 2025. Now layer in General Mills, GIS, yielding 4.92% with a 58.5% payout ratio, right in the healthy range for dividend stability. It's been paying dividends for 31 years straight, with 6 consecutive years of increases. The annual dividend is $2.41 per share, with recent payments of $0.61 per quarter. While recent returns have been negative 15.11% over the past year, that's the trade-off. Consistent income, even if share price growth is muted in certain markets. We left off in summer, pairing XLP with General Mills, a GIS, for stable, recession-resistant income. Now it's time to finish summer and move into our final season, fall. Why summer works. Consumer staples like those in XLP and General Mills specifically help balance the more cyclical sectors in your portfolio. Even when the market swings, people still buy food, household goods, and personal care items. This means you can lean on them for reliable income while other sectors might dip. By this point in the strategy, you've got 3 streams feeding into different months. Winter, utilities, XLU plus DUK. Spring, real estate, VNQ plus Realty Income. Summer, consumer staples, XLP plus GIS. But we're not done, because fall is where we add a powerful income booster. Season 4, Fall, Energy Dividends and Inflation Hedge. ETF, XLE, Energy Select Sector, SPDR Fund. Stock, Enbridge, ENB. Energy is one of the few sectors that can serve as both an income generator and an inflation hedge. When inflation rises, energy prices often follow, and that can flow through to higher profits and dividends. XLE has an expense ratio of 0.08% and a weighted average dividend yield of 3.40%. Over the past decade, it's averaged 5.37% annual returns, and its one-year return, to June 30th, 2025, was negative 3.91%. Recent payouts include $0.72 per share in June 2025 and $0.72 per share in March 2025, both quarterly. Now, the stock pairing. Enbridge, ENB. This Canadian energy infrastructure giant is famous among dividend investors for its high yield and consistency. ENB currently offers a 5.79% dividend yield, paying $3.77 annually. That's $0.94 per share each quarter. It has a payout ratio against earnings reported around 128% to 133.5%, which might sound high, but for pipeline companies using cash flow as the key metric, it's more appropriate to evaluate dividends against distributable cash flow, DCF, and management targets a 60% to 70% payout of DCF. The real kicker? Enbridge has paid dividends for over 70 years straight and raised them for 28 consecutive years. While its past year performance has recently improved, longer-term annualized returns sit around 5.09% over 10 years, steady for an income-heavy stock. Why fall completes the year? With XLE's broad energy exposure and ENB's high-yield quarterly payouts, you now have your final seasonal layer 1 that can thrive in commodity upcycles and act as a hedge when inflation bites. Together, winter, spring, summer, and fall create a portfolio calendar where cash flow is far more predictable than with a random stock selection. How the four-season strategy works together. Let's zoom out for a second. Here's what you've built. Winter, XLU plus DUK. Steady, defensive income from utilities. Spring, VNQ plus O. Real estate diversification plus monthly cash flow. Summer, XLP plus GIS. Consumer staples for stability. Fall, XLE plus ENB. Energy exposure and high yield. Instead of having dividend droughts for months at a time, your portfolio is now designed so at least one core holding is paying out every few weeks. The benefits beyond income timing. 1. Sector diversification. You're not putting all your eggs in one basket. Each season represents a different part of the economy: utilities, real estate, consumer staples, and energy, so you're reducing the risk that one sector's downturn will crush your income. 2. Blended yields. The ETFs give you stability with yields in the 2 to 4% range, while the individual stocks like ENB and Realty Income can push your portfolio yield higher. 3. Dividend growth potential. Many of these names, Duke Energy, Realty Income, Enbridge, have decades-long streaks of dividend increases. That means your income has the potential to grow over time, even if you never buy another share. Let's say you invested $25,000 in each season, $12,500 in the ETF, $12,500 in the stock. That's a total of $100,000 across the year. At the current yields, XLU plus DUK, AVG, approximately 3.09%, approximately $775 per year. VNQ plus O, AVG, approximately 4.76%, approximately $1,190 per year. XLP plus GIS, AVG, approximately 3.83%, approximately $958 per year. XLE plus ENB, AVG, approximately 4.60%, approximately $1,149 per year. That's roughly $4,069 in annual dividends before factoring in dividend reinvestment or future growth. Now imagine turning on DRIP, dividend reinvestment, and letting that snowball for 10, 20, or 30 years. Historically, many of these holdings have increased dividends every year, which means your income potential can compound in a way that's almost invisible at first, until it suddenly becomes life-changing. This isn't a magic bullet. Even with diversification, your portfolio will still face risks. Sector volatility. Energy can swing hard in down cycles. Interest rates. Higher rates can pressure REITs like Realty Income. Currency exposure. Enbridge trades in Canadian dollars, so currency fluctuations can affect returns. Market downturns. In a broad market sell-off, all sectors can drop at once. That's why it's key to review your allocations at least once a year and make sure the balance still fits your goals. Before this, your dividends might have looked like a messy chart spikes one month, nothing the next. Now, with the 4-season dividend strategy, you've designed a system where income is steady, diversified, and positioned for growth. This isn't about chasing the highest yield or timing the market perfectly. It's about owning assets that keep paying you, season after season, year after year. Future pacing. Picture this. It's December, and while everyone else is stressing about market headlines, you're reviewing your quarterly income report. You see payments from utilities, REITs, consumer staples, and energy all arriving on schedule. You're not guessing when your next dividend is coming. You already know because the calendar is built for it. If this breakdown helped you see how to structure your portfolio for consistent, year-round income, consider subscribing so you don't miss the next strategy. And if you're ready to start building your own seasonal dividend calendar, start with just one season. The sooner you begin, the sooner your portfolio can start paying you back.